Good morning, everyone. I'm Amanda Gerber, Marketing Director with DWD. Thank you for your interest in our session today, Fiscally Speaking, Gaining a Better Understanding of Nonprofit Financial Statements. For those of you that have questions during the presentation, please submit them using the chat feature. We will be answering your questions throughout the presentation as well as at the end. There will also be a brief survey following the webinar, and we would appreciate any feedback you could provide. With us today, we have DWD's Nonprofit Services team, Carrie Minnick, Susan Berghoff, and Tyson Moore. These three individuals specialize in assurance, tax, and consulting services specific to the nonprofit sector. At this time, I will turn it over to Carrie.
Thanks, Amanda. Just for those of you that came in a little bit late, if you do have questions throughout the seminar, feel free to submit those to the Q&A. And we will answer those throughout, but then also we'll have some time at the end as well. So just before we get started, I just want to remind everyone what nonprofit really means. Nonprofit does not mean an organization cannot or should not make a profit. I know that's sometimes what people think when they see the term nonprofit. A nonprofit is an organization that uses its surplus revenues to achieve its goals. So it's putting its surplus back into the organization to continue to provide programming versus a for-profit that is going to pay out those revenues to its owners or shareholders. The mission of the organization of a nonprofit is the main goal. However, we need to have profits in order to sustain our organization. So let's just keeping that in mind that nonprofits can make a profit. So I know we have a lot of different various roles of people with us today, board members, EDs, staff. But as a board member, you have certain responsibilities. So for those of you that do serve as a board member for nonprofit organizations, two of those that specifically relate to financials are ensuring adequate resources and protecting assets and providing proper financial oversight. So what does this mean? Well, for ensuring adequate resources, the board is responsible for ensuring that the organization has the funds that it needs and it does not spend beyond those needs. Do we need to develop more diverse sources of revenue in order to keep our programming going? As far as protecting the assets and providing proper financial oversight, as a board member, you need to ensure that the resources are used to accomplish the mission. We need to ensure that financial health and that contributions are used in accordance with donor intent. So if a donor says that its contribution should be used for a specific purpose, we want to make sure that it is being used for that purpose. We need to review the financial statements regularly, comparing those financial statements to budget. And then also, if we do have an audit, we need to engage that independent auditor and be in communication with them. Now, these are responsibilities of all board members, not just the treasurer. So a lot of times boards rely heavily on the treasurer, which is fine because they're usually the ones that have the most financial background, understanding. However, as a board member, all board members should have an understanding of the organization's finances. So who's looking at your financial statements? Obviously, management, the executive director, the CEO, the top person, they are going to use your financial statements in managing the operations. The internal financial statements may be formatted a little bit different than those for external use. Usually those internal financial statements include budgets, maybe on a different basis, but still those financials are used by management, as well as the board of directors, who hopefully looks at those quarterly or monthly. Your donors and funders are going to review your financials. Oftentimes, a donor or funder will request either interim financials or maybe an audited financial statement if they provide you with a grant. Reporting agencies such as federal government entities or state government entities may request financial statements, again, as part of the funding that they provide to your organization. Bankers. If you have a loan through a bank, they are interested in how well your organization is doing. They're going to look at cash flows, liquidity, current ratio, those types of things. So bankers obviously are very interested in your financials. Your auditor is going to look at your internal financial statements. That's the basis of what they use to perform the audit. And then the IRS. Well, whereas your financial statements are not specifically submitted to the IRS for review, the information provided in those financial statements is reported on your annual Form 990, which is then provided to the IRS for their review.
Carrie, I have something to add here.
Sure.
In the past, I've been asked by clients, is my not-for-profit required to make my financials available to the public? Maybe you can talk about some of the ways they can do that as well.
Sure. Yep. Nonprofits are not specifically required to make their financial statements available to the public. The 990 form they are, however, the financial statements they are not. However, they can choose to do so. I know a lot of organizations will put their financial statements on their website for people to view. It's really up to the organization as to whether they decide to do that or not. One of the pros of doing that is that you are making your organization more transparent. And especially the IRS sees that if an organization is more transparent, they're more likely better managed, better governed, that type of thing. There is a question on the 990 that asks how your organization makes your financial statements available to the public. And again, it is not, there's no law, there's no requirement that you have to make your financial statements available. However, many organizations do so. So again, it's really up to the nonprofit as to whether they want to make that available to the public. And oftentimes, if they do decide to do that, they'll just post it on their website. So before we get into the actual looking at financial statements, just want to go through a few background things that we want to touch on here. First of all, there are different bases of accounting that an organization can follow for their financial statements. The first is the cash basis. So this is the easiest to understand and the easiest to record. So this is just like your checking account at home. Your revenue and expenses are not recognized until money is exchanged. So when you get your paycheck, that's when you record it as revenue in your checking account. And when you pay your utility bill, that's when you record that expense. So very easy, especially for cash flow purposes, for the board to review and tracking, that's probably the easiest to manage an organization. Next is the accrual basis. Under the accrual basis, revenues and expenses are recognized when an obligation is made. So, for example, pledges receivable is very specific to nonprofit organizations. So an organization is going to record in revenue when they are notified that they are going to get a pledge in the future. So for example, if you get a award letter from a foundation that says, I'm going to give you $300,000 over the next 3 years, you are going to have to record that whole $300,000 in revenue as of today when you got that revenue, when you were notified that you're going to get that revenue in the future, even though you're not actually going to get the cash until the future years. Now that it will be recorded as restricted money, but you do need to record it in revenue when it is received. And then on the opposite side, for expenses, you're going to record your expenses when incurred. So for example, if you order something or if you have service provided, but yet you haven't paid for it yet, they haven't sent you the bill, or you haven't paid for it yet, you're going to record that expense when it is incurred as a payable. And then when you pay it, the payable is going to go away, but the expense has already been incurred. So there's a lot more to the accrual basis. So that's something to think about when choosing what basis you want to follow. Then there's the modified cash basis, which is kind of a combination of both the cash basis and the accrual basis. So under the modified cash basis, we're going to record revenue and expenses when they're recognized, or I'm sorry, when money is actually exchanged. But then we're also going to normally record fixed assets and depreciation, maybe the fair value of investments, payroll liabilities. So these types of things aren't normally recorded under the cash basis, but so that's why they're called modifications, but they give a little bit more disclosure as to the assets that the organization owns, and especially with the fixed assets, that type of thing. So we'll take a look here on the next slide, just kind of some comparison between the three bases. For the first column here is the cash basis. And as you can see, we have cash, and then we have some investments, and then the beneficial interest. The beneficial interest is really the investment with like the community foundation. So we don't have any liabilities because under the true cash basis, we're not going to record any liabilities. Everything is going to be run through cash. The second column is the modified cash basis. So again, we have a few modifications. We still have cash. We still have investments in beneficial interest. However, you'll notice that these balances have changed because we have added like unrealized gain and loss to these. So those balances will change. And then we've also finally added fixed asset. And then down below in the liability section, we've added some accrued payroll and withholdings. So these would be like the payroll taxes that have been withheld from your employees' paychecks that haven't been remitted yet. And then in the final column, we have the full accrual basis. And you can see there is a lot more numbers in this column. So not only do we have the cash, fixed assets, and investments, we've also added claims receivable, contributions receivable, prepaid, accounts payable, accrued with payroll and withholdings. So you can see there is a big difference between the balances of the three different bases that you can choose from. And this is just the balance sheet. So there's also going to be differences in your income and expenses as well. So that's something to think about too when you choose what basis you want to use.
Carrie.
Yes.
What is the type of basis called when you do everything except for put your receivables on the books?
Yes, so there is another kind of basis that we often see, which is kind of where you just do whatever you want to. Let me rephrase that. So you try and do the accrual basis, or you try and record your prepaid, your fixed assets, your payables, but maybe you don't record receivables, or maybe you're not recording accrued payroll each month. So it's not really the full accrual basis. It's not really modified cash basis. It's really not. It's not GAAP. And if you were having an audit done, we really wouldn't be able to do that because it's an exception from GAAP. It's not following GAAP. However, we often see a lot of nonprofits follow this type of basis internally, which is fine. It's okay if you want to record all the accruals on your internal financials except for receivables, or except for prepaids, or except for some other accrual. However, you need to make sure that everyone is aware that that's what you're doing. So when the board looks at that, when management looks at your financial statements at the end of every month, they are aware that you are not recording receivables. And at the end of the year, when you have your audit done and it's done on the GAAP basis, on the accrual basis, there is going to be some adjustments. So your receivables are going to be increased, your revenue is going to be increased most likely. So there will be some changes. So if you do choose to follow that type of basis internally, it's okay. It's not necessarily technically correct. However, you just need to make sure that everyone is aware of what you are and are not reporting. And you also want to make sure that you are consistent in how you are doing that.
Hey, Carrie, I've got a question.
Sure.
Something I've been asked before is a not-for-profit required to follow a certain basis? And maybe you can talk about switching in between bases. Is that something that they can do?
Sure. So unless your bylaws say that you are required to follow a certain basis, or if you get some kind of grants, either from the government or some kind of other type of funder that requires you to be on a specific basis, no, there is no legal requirement. There is no nothing that says that nonprofits have to follow a specific basis. So it's really up to the nonprofit on what basis they follow. Again, the accrual basis is really going to encompass all of your activities. So it's going to provide a better picture, a true picture of what your organization is doing during the year. However, it does take more time. It's more complex than just the cash basis or the modified cash basis. Many small organizations will just follow the cash basis because it is easier. It's easier to manage monthly the ins and outs of the cash. But again, it's really up to the organization as to what basis they follow. And then your second part of that question, you do not want to switch between bases. You want to go, if you're going to do the cash basis, that's what you want to do. Or if you're going to do the accrual basis, that's what you want to follow. You don't want to be switching in between because that's not going to give you consistent reporting from period to period to look at and to compare. So whichever basis you go with, you want to make sure that that's the one that you follow and consistently move forward with.
Okay.
So along with the different bases of accounting, we also have different types of financial statements. So we have our internal financial statements that are prepared monthly. Usually, they're unaudited. Usually they are prepared, obviously internally, but they may focus on a statement of activities. They might not have a statement of financial position or balance sheet. You probably don't have a statement of functional expenses. You probably have your revenue and expenses compared to budget versus an audited financial statement or a reviewed financial statement that is prepared by an independent CPA, which is usually prepared annually. Normally, audits are prepared on the accrual basis. However, again, there's no requirement that they have to be, but that's usually what they are prepared on because the audit is normally being done for a grantor that requires it to be on the accrual basis, but again, not a requirement. And then audited financial statements also include footnotes that describe the accounting principles used and additional information to the numbers in the statements. And then they also include an opinion whether the financial statements are presented fairly in respects to generally accepted accounting principles or whatever basis that they are on. So there is a difference between the two, and the ones we're going to look at today will be more looking like the audited financial statements. However, the things that we talk about can be applied to your internal financials as well.
Carrie, can you talk about items that can trigger an audit?
Sure. So not every nonprofit needs or is required to have an audit done. Again, your bylaws may require you to have an annual audit done or maybe biannual. We see a lot of organizations, especially churches, will have an audit done maybe every 2 years or every 3 years. So that's one place that you want to look to see if your bylaws require you to have an audit done. A lot of times an organization, a nonprofit will have an audit done if a funder requires them to do so. So if you are going to get grants from a specific funding source and they require you to submit audited financial statements, obviously you want to provide that so you can continue to get funding from them. Sometimes, however, funding sources will require an audit. However, maybe you can get by with a review. So that's another second place to look. If an organization spends over $750,000 in federal government money during the year, then you are required to have a specific type of audit done, a single audit, which includes more than just financial statement audit. So that's one thing to look at. So if you get government money, you just want to watch to see how much you are spending because you might reach that threshold, which will require an audit. One thing about an audit, many times people will think, oh, we'll have an audit done to make sure we're not having fraud. That is not our job. Our job is to come in and make sure your financial statements are in compliance with GAAP or whatever basis of accounting. As part of the audit, we look at your controls. We don't test controls, but we look at your processes and your procedures in place to see if they're reasonable and to gain an understanding of the organization. But the main purpose of an audit is not to find fraud.
So Carrie, for a not-for-profit that is currently not having any audited statements done, how often would we recommend that they have an audit if they choose to?
Well, for our purposes, it's much easier to have an audit done every year, just because when you have an audit done, you're not only looking at the current year activity, but you have to make sure that the beginning balances are correct as well. So I think if you start having an audit done, it's just easier to continue to have an audit done every year. However, there are different, it's really up to the organization. Again, we see sometimes some organizations that will have an audit done every other year, every 3 years. They might have a review done in those off years, just to, get somebody in there to make sure to look at the information, not as in depth, but to have that extra oversight. Sometimes we see organizations that will have an audit done when they have a new executive director, just to get that extra oversight in there. So I think once you start having an audit done, it's probably just easier to continue to have an audit done, because that way you're getting that continuous extra oversight, and it's also forcing you to make sure all your ducks are in a row, that you're having everything looked at annually. I think it's just much easier once you start to continue with that. Now, if you've never had an audit done before, something to consider that first year is maybe having a review done and agreed upon procedures. So a review will look at your numbers to make sure that they look reasonable, that part of the review. But then we often do an additional agreed upon procedures, where we will look at the policies and procedures that are currently in place, and the processes that are currently in place. So that way we can kind of get you ready for the next step for the audit. So like a training wheel, is kind of going through some basic stuff first before you really jump to that audit step. So if you're not currently having an audit done and that's something that you want to work towards, you might consider having a review and agreed upon procedures done that first year.
I have another question that came through. Is there a recommended action that would address the fraud concern and the fact that an audit doesn't find fraud, but is there another thing that can be done?
Right. So if you are concerned about a certain area of your organization, you could have, there are actually fraud examiners, but we also, as an independent CPA, can do agreed upon procedures on certain areas. So I know in the past, someone may be concerned, not necessarily think that fraud was happening, but maybe concerned that maybe your deposits weren't being deposited correctly. So what we do is come in and we specifically look at your deposits. So for example, maybe we select so many deposits during the month or during the year, and then we trace them through the process. Okay, where's your supporting documentation that supports these amounts that were recorded? Let me see your bank statements to make sure that they were actually deposited. Let me see your general ledger to make sure that they were actually recorded correctly. So if there are certain areas that you are concerned about, that's kind of where an agreed upon procedures comes in, and we can focus more on specific areas. Because obviously during an audit, we don't look at every single thing, but during an agreed upon procedures, we agree upon what we are going to look at. So whether that's your receipts or your payroll or whatever area it is, we can certainly focus in on that area, and then we issue a report to our findings.
I think another thing to remember is that even when we are doing an audit, and the expectation might be that we will find something, but if we do, we let you know. But the real important part is communication, and that you should communicate to us that you have ideas or doubts or concerns, so that we can adjust our audit procedures accordingly.
Correct. Right.
Thanks.
Oh, go ahead.
No, that's fine. You can go ahead.
Okay. Next, we just want to talk a little bit about budgets as well, just because I referred to internal financial statements normally have budgets with them, which is great because we want to, a budget is a plan for the year, and we want to make sure that we are following that plan. In order to do so, we want to compare actuals to what our plan is. So, but the biggest thing on budgets is we have to have an understanding of what assumptions are in that budget, and is your budget realistic? So they're not just numbers on a page. It's an active document where you shouldn't just prepare it at the beginning of the year and then stick it on a shelf. So we need to really understand what that budget is telling us, and then also when we compare it to actual if there's differences, why are there differences? Was it because something happened during the year that we weren't expecting? Or was it because we just didn't understand the costs that were related to that item? And we maybe, next year when we do the budget, we really need to adjust that. So when you're looking at internal financials with budgets to actual, that's something to make sure that you're looking at is those comparisons, variances, and also unbudgeted items, and ask those questions. And then obviously we have nonprofit versus for-profit. So a lot of people maybe are more familiar with for-profit financial statements. So there are some specific terms that nonprofits use. We use net assets as opposed to retained earnings. As opposed to net income or net loss for the year, we use increase or decrease in net assets. We also have contributions. For-profits don't receive contributions. We also have donor restrictions. So when someone gives a contribution or a grant to a nonprofit and they say that it needs to be spent on a specific purpose or for a specific time period, that's what that refers to. We also have board designations. So the board can set aside money for a specific purpose, and then also functional expenses. So we allocate our expenses not only by natural classifications, which for-profits do as well, as far as salaries, payroll taxes, supplies, but we also allocate them by function, so by program management in general and fundraising. So when we're looking at the financial statements, there's 4 items of a set of nonprofit financial statements: the statement of financial position, the statement of activities, the statement of functional expenditures, which is now required for all nonprofit organizations, and the statement of cash flows. And you can see here the comparative in the for-profit world. One thing to keep in mind about these financial statements is that all these statements are connected. They intertwine with each other. And really this is it's telling your organization's story in numbers. So the first statement that we are going to look at is the statement of financial position. So the statement of financial position, or the balance sheet, is as of a specific date and time. It shows your assets, liabilities, and net assets, as well as a total of each class of net assets based on donor imposed restrictions, any kind of restricted cash. And one thing to remember is that assets have to equal liabilities and net assets. So as we take a look at these set of financial statements here, the first thing we'll notice is at the top, this is as of a specific date. So these statements are as of June 30, 2020 and 2019. So here's the 2020 column, here's the 2019 column. Again, these must agree. So in both columns, your total assets must equal your total liabilities and net assets. So we have to make sure if these do not agree, your financial statements are wrong. So when we're looking at this, let's kind of go through and see what specific items that we should be looking for. So these items at the top are your current assets. So your cash and cash equivalents, that's going to be your checking account, your savings, your money market account, contributions receivable. Now, some of these contributions could be long-term and they could be short-term. So contributions receivable are those promises that people said that they were going to give you. It may be promises that they are going to give you next year, which would be considered current or short-term, or it could be promises that they are going to give you after next year. So 2 to 5 years and on, that would be considered long-term. Prepaid expenses are those expenses that you paid for in advance. A lot of times that refers to insurance, because usually insurance does not match up with the same fiscal year that you have. So oftentimes you will prepay for a certain portion of insurance. There can be other items that are prepaid as well. I know this year, with COVID, a lot of special events were put off. So you may have paid for the facility this year and you didn't use it. And so that's prepaid because you're going to use it in the future. Cash restricted for long-term purposes. So this is money that you have received from someone to either for the endowment or to purchase like fixed assets. So for example, maybe this $100,000 was a combination of donations received to build a new building. So because that building is going to be in fixed assets, we have to separate that cash from our normal operating cash that's up here. Obviously, investments, pretty self-explanatory. Property and equipment, that is going to be your furniture, your buildings, your land, those types of items. Beneficial interest, that's going to be your investments at the community foundation. The community foundation has 2 funds, at least in Allen County. They're referred to as Fund 1 and Fund 2. I know in other counties, they often also have the 2 funds with variance power and without variance power. And so this is the one that is considered the one that is an asset to your organization. So that's basically the community foundation investment. And then down below, these are our liabilities. So the assets is what you own or what people are going to pay to you, your receivables. And then down here is your liabilities, what you owe to other people. And these terms, these names over here on the left here, these are not all encompassed. There are other items that can be listed here. There are other terms that can be used. Property and equipment might be called fixed assets, or if you just have equipment, it could be equipment. These are kind of standard terminology and very common items that you will see on a statement of financial position, but this is not an all-inclusive list. So under current liabilities, these are the liabilities that are due. These are the items that are due in the next year. So your line of credit with the bank, accounts payable. So those are going to be the services that have been provided to you or the items that you have purchased that you haven't paid for yet. Accrued payroll and withholdings are going to be, again, related to payroll, either payroll that has been earned and not paid, or taxes that have been withheld and not remitted yet. Deferred revenue is money that you have received for something that you are going to do in the future. So for example, maybe you provide counseling and you received revenue to provide this counseling in 2021. So you haven't done that exchange portion yet. You haven't provided the service yet. So it's kind of sitting in this holding account, in this liability account, until you actually provide the service. Refundable advance, that's going to be the PPP loan. So for nonprofits, one way to record the PPP loan that has not been forgiven yet is as a conditional grant. And that is considered a liability until it is forgiven. So that's in a separate line item here. And then capital leases payable are those leases that are viewed more of as a note, a loan versus an operating lease. And then down below, we have our net assets, which is our equity. So this is basically an accumulation of earnings that we have had over the years that we have been in existence. And again, we said that these financial statements flow to each other. So this cash up here is going to flow to our statement of cash flows. And then down here, our net assets comes from our statement of activity. So all these numbers intertwine together. So when we look at our nonprofit's financial statements, specifically the statement of financial position, so what should we be looking for? What should we be asking ourselves? So again, we want to make sure that these balance, because if they don't balance, then the financial statements are wrong. We need to go back to the drawing board. But when we're looking, hopefully we can see current year to prior year, or current month to prior month, or current month year to date versus prior year to date month. We want to look at the variances between these different balances. Why are things increasing or decreasing? What is expected versus non-expected? For example, the line of credit took a huge decrease. Well, I know that we paid our line of credit off, so that should be zero. That makes sense. But some other variances, for example, if our receivables keep going up, is that because we can't collect receivables? Are we having issue collecting receivables? Or opposite, if our payables keep going up, is that because we're having cash flow issues where we can't pay invoices timely? So those are some things that we want to look at. How much cash do we have up here? Hopefully this number is not zero. We want to make sure that we do have cash. Do we have a healthy cash balance? How much cash do we have in our reserves? Normally, best practices is having 3 to 6 months. Is the recommended cash balance to having reserves as far as covering operating expenses that are equal to 3 to 6 months of expenses. What's going on in our investments? So is investments going up or down? You know, if the market tanks, then we're going to expect to see our investments go way down. Or if we had a huge donation of investments, we are going to expect our investments to go up. So we want to look at that type of thing. What risks are related to our investments? Hopefully, as a board member, you have an understanding of what type of investments that you are investing in. Is it stocks? Is it bonds? What kind of risks are related to those? When we look at property and equipment, fixed assets, what is the age of our equipment? Are we going to have to replace a bunch of equipment or buildings or vehicles relatively soon? And if we do we have enough cash up here to do that? As far as payroll, this payroll and withholdings, we want to make sure that we are remitting our payroll taxes timely. That's one thing that the IRS is big on, is making sure that they are getting payroll taxes paid in. So we want to make sure that we are always current with payroll taxes and withholding. Also, when we're looking at current assets up here, we want to look at current liabilities as well. So if you know, someone came in today and said, okay, you have to pay off all of your accounts payable and your accrued payroll withholdings, which is about what, $60,000 to $63,000 down here. Do we have enough cash to pay those off? And we do, which is great, but some organizations don't. So that's something to keep in mind too, is if when we're looking at ratios and variances, do we have enough cash up here to pay off our debt if we had to today? And then also down here are net assets. So again, this is our accumulation of wealth basically since the beginning of our organization. We have one section without donor restrictions and one with donor restrictions. So without donor restrictions is people gave you money, you can do with it whatever you want to, the contribution. With donor restrictions is I give you $10,000, but you have to use it on program X, or you have to use it in fiscal year 2020 or fiscal year 2021. So that is a donor restriction. And it is very important that the nonprofit follow that restriction and follow the donor's wishes for spending that money. Only donors can restrict money. So a board cannot restrict money. A board can designate unrestricted funds, but only a donor can restrict money for a specific purpose. And when we're looking at our net assets, we really want to make sure that this without donor restrictions is positive, because if this number is negative, that means we had to borrow from our with donor restrictions, and we really don't want to do that, because that means that we had to use money that was given to our organization for a specific purpose, not for that specific purpose, but instead to fund our operations. So that's one thing to look at when you're reviewing your financial statements, is making sure that this number is positive, because this is really what we have to use to pay for our daily operations. One other thing related to the statement of financial position, there are some policies that are related to some of these items that you might want to consider having in place. And these policies are just best practices, recommendations. There's no really law that says, or requirement that says you have to have these in place. A cash reserve policy, as I said, 3 to 6 months of cash on hand to cover 3 to 6 months of expenses is best practices. So if you choose to have some kind of reserve in place, you want to make sure that you have a policy in place to show what the funds are for, how it can be used, how it will be replenished. Investment policy and endowment policy. If you have investments or if you have an endowment, you want to state what these investments are going to be invested in. Are you just keeping them in bonds? Are you going to invest in stocks, CDs? What are the goals? Is it long-term investment, for a long-term return on your investment, or is it, do you want quick returns? Capitalization policy and asset replacement plans relate to your fixed assets. So when you purchase items, what is the dollar amount and useful life for purchases that will be capitalized as opposed to expenses? Oftentimes it's $500 or $1,000 for nonprofits. However, again, those are just, usually what we've seen. There's no requirement that it has to be one of those. So that says that, your computers, your equipment, your furniture that is purchased that is a cost of $500 or more is going to be capitalized and depreciated over the life versus expensed all in that first year. Asset replacement identifies when your current assets need to be replaced. So when are you going to have enough cash or loans or gain contributions to replace your fixed assets? Because obviously your fixed assets are important to your organization to be able to carry out your programming and operations. So you're going to have to make sure that you know when those items need to be replaced. And then finally, board designated net asset policy. So if again, only donors can restrict money. However, boards can designate unrestricted funds. So they can say, okay, for all estates that we get, estate gifts, we are going to set those aside and put them in our reserve. Or we are going to build a new building pretty soon. So we are going to start designating all gifts over X dollar and put those in this fund. So we really should have a policy in place as to what we're designating those for, how it can be used, and what if you don't get enough? So having a written policy in place for your board designated net assets, if you have those as well. Moving on to the statement of activities. So this is basically your income statement. It's going to show your revenues less expenses equals your net income for a specific period of time.
Carrie.
Yes.
Can we go back just one?
Sure.
For the related policies, are there boilerplates for these policies?
Yes, yes. So we have all of these policies and that we're going to talk about today. Obviously there's, you can Google and they're out there, but we also have policies, templates that we would be happy to share with you. So if you are interested in any of these, feel free to contact us. And we can certainly provide those. No point in reinventing the wheel. You just need to make sure that you tailor it to your specific organization, because each organization is going to be different, but we would be happy to provide those to you. All right, so the statement of activities. And again, we'll start out with, as opposed to the balance sheet, the statement of financial position, which was for one day as a point in time. This is for the year ended. So we have 2 years here. So this is 2020 and this is 2019. So each has a total, 2019 total, 2020 total. So as we look at these, we have a column that says without donor restrictions and with donor restrictions. So when you look at your financial statements, really, this is the total. However, this column here really has to do with timing. So during 2020, this organization received $894,000 of revenue for a specific purpose. Actually, 894,000 less the 85. So they received money for a specific purpose or for a specific time period. And then when that money is spent for that specific time period or for that specific purpose, it is moved from this column over here to this column. So as you can see, there is no change, no effect on this column. Basically, it's just moving from, let's say you have money and you put it in two pockets, your right pocket and your left-hand pocket. That's just what these are. They're two different pockets. It's all organizations' money. It's just separating it. And then we're moving it from the right-hand pocket to the left-hand pocket when we're spending that. So I know sometimes this is kind of confusing as far as restricted, but really it's just, this column is really a timing difference. So as we look at this, the top part is going to be your revenue. So nonprofits get revenue from various sources, contributions and grants, membership fee. This organization has members. Program fees, if you provide some kind of service and you get paid in return for that, that would be your program service fees. This organization has some rent income, so they do rent out part of their facilities. And then they have some other income, some investment income and gain on investment. So when we're looking at this, We want to consider where all of our revenue sources come from. We do not want to rely heavily on one source of revenue or one contributors, because if that contributor or if that source of revenue were to suddenly disappear, how would we be able to continue on? For example, if this organization suddenly, something happened to all their members and they can no longer get membership fees, that would drastically impact their organization, and all of this funding source would be gone. So what are they going to do? So we want to make sure that we diversify our revenue sources up here at the top. As far as one other thing with revenue, I just want to touch briefly on unrelated business income. When you're looking at your financial statements here, we want to consider if any items are unrelated business income. So these are going to be revenue that is not directly related to our mission and what we're doing. It's okay to have unrelated business income. However, you have to pay taxes on it, just like a for-profit, and you have to make sure that you don't have too much of it. To be considered unrelated business income, it's based on what drives that revenue, where it's coming from. It does not matter that you're putting that money back into your organization to use for your mission. So when you're looking at up here, for example, rent income could be considered unrelated business income if there is a mortgage on that building. So when you're reviewing your income sources, you just want to, that's one thing to consider, is if there is unrelated business income. And then moving down here to our expenses. So this is what we're spending our money on. You're required to allocate expenses between 3 functions: program, management, and general. So this organization actually split it in between 3 programs. So depending on how big your organization is and what kind of programs you have, you may have just one program here, or you may have several. It just depends on the organization and how significant those programs are. Program expenses in these lines up here, they are the costs that are directly and indirectly related to providing program services. So again, if you're doing counseling services, that's your program. That's going to be the salaries for the counselors. That's going to be the supplies that they use when they're doing the counseling, that type of thing. Management and general expenses relate to the overall operations of the organization, and they are not identifiable to a specific program. So again, these are expenses that you have because you're running a business, not necessarily the type of business. So your audit expense, that's management in general. That does not specifically relate to a program. Now, you might have to have an audit done because you get a grant for a specific program. However, the expense, that audit expense, is not directly related to a program. So that's going to be management in general. Your payroll fees that you pay your payroll provider, that's going to be management in general. That's just an expense that you have in doing business. And you have to have overhead. You have to have these expenses. So they're not bad. They're just classified as management in general. And then fundraising are the costs that are related to inducing potential donors to contribute to the organization. So, if you send out flyers asking for money, or the time spent on holding a special event, that type of thing, trying to get people to give to your organization. So, and then we come down here to the bottom line, which is our change in net assets. So you'll see that this number here is positive, which is good. We want to see more revenue than expenses. However, this without donor restrictions, which is really our operations, is negative. So that means that we spent more here than we came in. So, just obviously sometimes these numbers become negative, but we want to see them positive. So when we are reviewing our financial statements for our organization, and we're looking at our statement of activities, before we can ask any questions, we really need to understand, first of all, what period are we looking at here? So are we looking at it for the year? Are we looking at it for the month? Especially with internal financial statements, what are we looking for? Month, only the month to date, quarter to date, year to date, what period are we looking for? Again, we want to look at significant variances between 2020 and 2019. And are these variances expected? One variance really that should be top of mind is there a significant funding source that has been lost? So for example, if there was a huge decrease in contributions and grants, why? Was that expected? Maybe there was a multi-year grant that was received and reported in 2019, but not in 2020. But why was there that significant decrease, and should we be concerned? Also at the top here, when we're looking at our different sources of revenue, are these sources correct? Are they disclosing what we want to disclose to the reader of our financial statements? For example, we have a line called contributions and grants. That's fine for this organization. However, maybe some other organization would want to pull out in-kind contributions. So those non-cash items that we get, maybe we get a significant amount of non-cash donated items, and we don't want to bury those in here with our cash contributions. So we want to split those out. And that's actually going to be a requirement here in a couple of years. So if you don't already do that, that might be something to consider. But again, they also combine grants with contributions. So maybe another organization would want to pull out grants and separate contributions and grants. So when you're looking at your organization statements, are these categories over here correct? Are they reasonable for your organization? Do they portray what you want them to portray to the organization, to the reader of the financial statements? Obviously, you're not going to include rent income and contributions together on the same line, but should other items be separated or combined? And then same way down here on expenses, are we just using one program? Is that all we do is one program, or should we separate out into multiple programs so we can truly see what we do, all of the things that we do for the organization? Also, as far as restrictions, if this number is really high and we have a lot of money that's restricted for a specific purpose or time period, we want to make sure we understand what that restriction is for, because sometimes organizations tend to get a lot of restricted money for a specific purpose, and what they really need is unrestricted money that they can use for daily operations. And if we get too much restricted money, are we going to be able to spend that? So make sure that you understand what this restricted money here is required to be used for. And again, we talked about this is just a reclass between one pocket and the other pocket. There's no effect here on total income. Again, this is your net income, change in net assets, net income for 2020 and for 2019. And then these, again, talking about the relationship between the different financial statements, these numbers here and these numbers here will flow to your statement of financial position. And then these numbers here will flow from your statement of functional expenses that will provide more information on those different types of expenses. So as we move into the related parties related to the statement of activities, there's just a couple that we recommend. Having a gift acceptance policy. So obviously organizations will receive cash contributions, but what about non-cash contributions or land or buildings? Do you accept those? And if you do or not, you probably want to put that in writing. Contribution substantiation, making sure that you have a policy in place to provide that proper documentation to your donors when they provide contribution. And then also expense allocation. And we'll talk about that in our next statement here, the statement of functional expenses. So this really provides an analysis of expenses by both function and natural classification. So again, we talked about the statement of activities. We have 3 different programs: management in general and fundraising. Both the IRS and generally accepted accounting principles require nonprofit organizations to allocate their expenses between programs, management in general, and fundraising. And so we should really have a policy in place as to how we are going to allocate those. It needs to be on a reasonable basis as to the costs for the different functions. And these numbers here tie to this previous statement of activities. And this really just gives additional information as to those expenses. So these are your natural classifications over here. And again, when you're looking at this statement, we want to make sure that these classifications are proper for our organization. When we are providing our statements to the reader, is this what we want them to see? Obviously, you want to break out salaries and related expenses, but do we want, occupancy and maybe we want to split out rent and utilities because rent is more significant or something like that. So there's no set requirement as to what you need to have over here. Obviously, you don't want to combine these all into one line as other expenses, but that's one thing to look at is to consider is how detailed do you want your organization to go. Again, the statement of functional expenses is for a specific period of time for the year ended. And as far as allocating expenses, there's no set standard as to what percentage of expense should be into each function. However, there are kind of best practices and recommendations as to how much should be in each area. The Better Business Bureau, they like to see at least 65% spent on program. Charity Watch likes to see 60% or more on programs. I believe the United Way of Allen County likes no more than 25% on supporting services. So it kind of varies. This organization here has a significantly high percentage on program. 89% of their total expenses is spent on program, 8% on management in general, and 3% on fundraising. So we want to make sure we have a reasonable basis in place to allocate those expenses. We don't want to fudge those numbers. Obviously, we have to have management in general. We have to have fundraising. However, we want it to be reasonable. And really the best practice is to compare your organization year over year to itself versus other organizations, because these percentages are going to vary based on how old the organization is, how long it's been in existence, what type of services it provides, that type of thing. And I know we're running out of time, so I just want to, and again, you'll have another statement of functional expenses for 2019, so you can compare those when you look at those two. The last statement is the statement of cash flows. This statement usually is not, obviously you don't provide one of these in your internal financials. It's usually not looked at very much by a lot of people just because it's not as easy to understand, let's say that. So you want to make sure that you have a positive cash or positive cash down here. So we want to make sure we have cash. The biggest thing on here is cash flows from operating expenses. So basically this statement says, where are we getting our cash from? What are we using it for? So their operations from cash is negative. So that means they spent more than what came in, which is okay. You really want this to be positive, but some years you're going to have negatives here. And then we have other activities, investing and financing. You have to move money into investing. You have to finance items sometimes. So it just kind of gives you a base of an understanding of what your money is being used from, where the cash is coming from. So when you're looking at this, really looking at this number here, you want it to be positive, but sometimes it will be negative. I know we're approaching our end of our time together. So just want to remind you that your financial statements really are telling your organization stories in numbers. Make sure that they are telling the correct story that you want them to tell to the reader, because again, your financial statements are out there in front of a lot of different people. There are requirements on the different statements. However, there's also a lot of leeway and flexibility on some of these statements as far as what is shown and how things are shown. So make sure that you understand what your organization's statements are portraying to the reader and that it is portraying the correct story. So I think we're out of time. So I thank everyone for coming today and attending. Thank you for your participation in your nonprofits. We will continue to have our monthly webinars. So if you are interested in attending next month, we will surely put that out and advertise it on LinkedIn and our website. You can see the upcoming webinars as well. The last slide here has my information, contact information. So if you have any follow-up questions that we didn't get a chance to answer, or if you'd like some of the templates that we talked about today, please feel free to contact me. I'm happy to provide those to you as well. Thank you again.